Good evening. Come to the paragraph on variable consideration. Examples of variable consideration. Situations when variable consideration can arise is discount, rebate, refund, credit, price concessions, incentive, performance bonus, penalties also. An entity shall include in the transaction price the variable consideration estimated above only if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur. So, when will you recognize variable consideration in the transaction price? When you think the significant reversal will not take place. Like, for example, you may include incentive. You are a contractor. If you complete the work in the given time, you'll get additional 50 lakh rupees. Will this be included in the transaction price? The answer is yes, if there is a high probability that this should not be reversed in future. Okay, when the uncertainty is resolved. So include variable consideration when there is a high probability. See one more example. On 1st April 2020, F Limited entered into a contract with H Limited to provide asset management services for 1 year. So what is this service? Asset management service. It is like portfolio management service. Okay. They will manage your funds, manage your asset. F Limited receives a semi-annual management fees which is based on a percentage of H Limited's asset under management at the end of each half year. So how is fees calculated? Fees calculated is based on asset under management at the end of each half year. So they will take this figure, asset under management, say 100 crore. Fees for asset under management suppose is 1%. So 1 crore fees. Okay. In addition, F Limited receives a performance based incentive fees of 10% of the funds return in excess of the return of an observable index at the end of the year. Now this revenue will depend on performance. Two types of revenue model is there. Fixed amount, which is 1% of asset under management. Whatever is the asset under management, just multiply by that fixed percentage. Second is performance based. That is 10% will be the fees if the return is in excess of the above observable index at the end of the year. Now this revenue is variable, correct? And plus it is uncertain also. Variable and the degree of uncertainty is high. You are dealing with market, stock market. Although such increment of service is distinct, that means you can say there are two distinct services. One is managing your asset and one is ensuring that your performance is above an index. F Limited accounts for the contract as a single performance obligation. But the way you are going to provide the services will not be different. Ultimately, you are going to manage the asset which will give you return only. Is it possible to differentiate these two obligations? No. Because in both cases, you are rendering the service of investment management. So F Limited will account for the contract as a single performance obligation. Managing a portfolio and charging fees which is fixed and some variable can be treated as a single performance obligation to provide investment management service for 1 year because the service have the same pattern of transfer to the customer. Is he rendering different service? No. Fees is charged on two bases, but the rendering of service is the same. He is managing your asset and aiming at a high return. Now, how to recognize revenue? To recognize revenue for satisfying the performance obligation over time, F Limited selects an output method for measuring progress towards complete satisfaction of the performance obligation. Now, when you use output method, there is a condition. Revenue will be recognized when the outcome can be estimated reliably. When the outcome can be estimated reliably, when the revenue has to be recognized over a period of time. Now, F Limited concludes that it is not reasonably assured to be entitled to the incentive fee until the end of the year. So, this means outcome can't be estimated reliably. If the outcome can't be estimated reliably, we should not recognize revenue. Okay? So, you cannot apply the progress method here because you are yourself saying, I am not sure whether the incentive will be earned at the end of the year. That you will get to know only at the end of the year. Although F Limited has experience with similar contracts, that experience is not predictive of the outcome of the current contract because the amount of consideration is highly susceptible to the volatility in the market. Outcome cannot be estimated reliably because market is volatile. Even though you may have past experience of generating excess return, the standard says or this case study says it cannot be applied in the current contract. In addition, the incentive fees has a large number and high variability of possible consideration amount also. Even the amount of consideration is fluctuating. It depends how much is the return of the portfolio and how much is the return of the index. So there can be a huge range of possible consideration. So what will be your judgment about the revenue recognition? Should we recognize 6 monthly revenue on the asset under management? Yes. Should we recognize revenue based on incentive, that is 10% of excess return over and above index return? Should both be recognized? None be recognized? Only one be recognized? Both, none, one. One. Which one? Which is based on asset under management. Every 6 months you will check what is the AUM, asset under management, and whatever is the percentage you have agreed you can recognize. Because there is no difficulty in estimating the transaction price and there is no uncertainty about the consideration. But with respect to the other one, because of uncertainty involved in the outcome of the contract and in the consideration amount, we will have to wait for a year. At the end of the year, only if you have generated excess return, then recognize revenue. So the answer is because F Limited is not reasonably assured to be entitled to the incentive fees, the cumulative amount of revenue recognized during the year is limited to the semi-annual management fees. Therefore, in accordance with IFRS 15, F Limited directly measures the value of the services provided to the customer to date by reference to the semi-annual management fees for which F Limited has a right to invoice. This revenue can be recognized. Semi-annual management fees based on AUM. In other words, semi-annual management fees is an appropriate depiction of the amount of consideration to which F Limited expects to be entitled in exchange for services provided in 6 monthly basis. With respect to that variable part, you have to postpone the revenue recognition because there is uncertainty about two things: outcome of the contract and second, amount of consideration. So this was a small discussion on variable consideration. Now, dear student, existence of significant financing component in the contract. This is also very important for exam purpose, that sometimes the transaction price may include financing component. Okay, so what I have to do, I have to divide that out of this transaction price, how much is the finance cost, okay, and how much is the amount for goods or service. If the time period is more than 1 year, then we'll apply this. If the time period to receive or make the payment is less than 1 year, don't apply this. Okay, like for example, so many times we discuss A sells goods to B for 3 lakh. B will pay after 3 years. This 3 lakh rupees includes some financing cost also. Sometime reverse happen. What is reverse? Customer gives you advance of 3 lakh today. You will deliver the goods after 3 years. Is it right? So in that case also, the transaction price is not 3 lakh. Customer is paying you 3 lakh. You are going to sell the product after 3 years. So don't you think you have to pay interest to the customer now? So the revenue that you will be recognizing is by adding interest for 3 years. And that is the amount of revenue you will recognize. So sometime customer may pay you advance, you may deliver the goods or service later. You may deliver goods or service now, he may pay you later. So in the first example, customer is paying interest to you, reduce it from the total transaction price. In second example, you are paying interest to the customer, add it to the advance amount and recognize interest as your expense. This will require adjusting the transaction price by discounting it with an appropriate interest rate. So this will be given to you in the problem, and recognizing the interest income when the customer delays the payment, or interest expense when customer pays you in advance over the financing period. This is not required if the time period between the transfer of goods and service is less than 1 year. Now we will solve one question. On 31st March 2019, Delta sold goods for a price of $12.1 million. Important question, because this will be part of a bigger problem. The terms of this sale allowed the customer to extend the credit, and the price was payable by the customer in cash on 31st March 2021. Appropriate discount rate is 10%. Okay. Then they will ask you the question, how much revenue should be recognized for this transaction for the year ended 31st March 19. So what you will do, since the amount payable is more than 1 year, you have to discount this transaction price. When you discount it, how much do you get it? 12.1 divide by 1.10 equal to 2 times equal to. Are you getting 10 million? Yes. So basically the amount of goods or service supplied is 10 million. Additional amount 2.1 million is your income, but that is another type of income called interest income. So on 31st March 2020, it would recognize a revenue of $1 million as finance cost and increase the receivable. On 31st March 2021, finance cost will be recognized for $1.1 million cumulative basis. And after 2 years, your value of receivable in the books will become 12.1. Collect the amount, account will be closed. Okay. So how do you pass the journal entries for this problem? 31st March 19. 19 is right. Debtors account debit 10 million to sales 10. 31st March 20. Debtors account debit 1 to interest income 1, and this interest income you will transfer to P&L account. 31st March 21, debtors account debit 1.10, 10 plus 1 11 into 10% to interest income, which you will transfer to P&L account. And one more entry, debtors will pay the amount, bank account debit to debtors 12.1. What is the next question now? Text go. Company entered into a contract with Mingo to sell a machine for $230. However, according to the terms of the contract, Mingo will pay the amount as agreed immediately, but the machine will be sold and delivered only after 12 months. Now, this is a question which is opposite to the first one. You get the advance, you deliver the machine after 12 months. Transaction includes the impact of the financing arrangement, and the finance cost on the advance received is estimated to be $20. So this calculation they have done for you. How much revenue shall Text Go company recognize from this contract on the date of sale when the contract is executed? How much revenue you will recognize? 230 plus 20, 250. So here the Text Go company has received 230 in advance, and the transaction includes the impact of financing arrangement. Text Go company needs to consider the impact of finance cost. Text Go company shall not recognize. What happened?
They are saying it is included.
Where it is included? Impact of financing arrangement. Transaction price nahi, transaction includes. Text Go needs to consider the impact of finance cost. See, read the full question, don't read one line and conclude. If you read the question, it is mentioned here that initially the value of the machine is 230 and the transaction includes the impact of financing arrangement. You are paying 230 because you are giving advance. Had you paid 1 year later, you would have paid 250. So that is why transaction includes the impact of advance payment. The price has been reduced specifically for you because you have paid the money in advance in 1 year. So TextGo will recognize the following. First you paid 230. 230 is the effect of advance payment. You are given 20, that is $20 discount because you are paying the advance. That means this figure 2 is 250 minus 20. Is it right? 250 is the value of that machine, but to the customer they are charging 230. 20 rupees advance or interest on advance is adjusted. Finance cost on 20 on advance received, as it is the finance cost related to advance received from Bingo company 12 months before the sale of the machine. It constitutes the cost of using funds which were received in advance. So revenue recognized will be 250. So how will you pass the journal entry in case if they ask you? First we'll write the entry, bank account debit 230 to advance from customer 230 at the end of the year or after 1 year, interest account debit 20 to advance from customer 20. One more entry, advance from customer debit 250 to sale or to sale of machinery. We don't know whether machinery is inventory or machinery is the fixed asset, PPE. Is it right? Is the machinery inventory for this company? We don't know. As far as revenue recognition principle is concerned, it is applicable for both inventory and PP because there is a financing arrangement. What happened? Next is non-cash consideration. Non-cash consideration. A sales to B some product, B sales to some product. How to account for this kind of transaction? These are also called barter transaction. Barter. Suppose A sells hotel room service to B. B sells telecom car, telecom service. That means they will give you so much of data against so many hotel rooms. Now, how do they recognize the revenue? Or any other such combination? I will give you Ind AS book, IFRS book, you work in the office for 2 months. No? Unviable. 2 weeks. 1 week. Okay. Chalo, deal done. How to recognize the revenue? Based on fair values. Based on fair value. You will recognize revenue because you are selling the hotel room service. This party will also recognize the revenue because it is giving telecom service. Consideration received is in non-cash form. So sometimes the customer may pay the consideration in a sale transaction in a form other than cash. In such a case, the entity will recognize the non-cash consideration received at fair value. If the entity cannot reasonably estimate the fair value of the non-cash consideration, one more option. If you can't calculate the fair value of consideration received, then calculate the consideration in the form of goods or service transferred. Okay. The entity shall measure the consideration indirectly by reference to stand-alone selling price of goods or service promised to the customer in exchange. So one small example we'll take here. Genius Limited, a company engaged in manufacturing computers and laptops, supplied 150 computers to Gemini under a contract. Genius. Gemini. What they have supplied? 150 laptops. In accordance with the contract, Gemini agreed to pay Genius by transferring the rights to one of its patents. What they have supplied? Patent. So non-cash consideration. Patent will allow Genius to improve the display quality of the computer screens. The fair value of the patent was estimated at 0.5 million. This is 0.5 million. The standalone price of each computer is 2500 into 2500. So multiply 2500 into 150. How much it comes to? 0.375 million? 0.375 million. Okay. So how they will recognize the revenue? Let us see. If the fair value of the patent was not available, then the valuation will be based on standalone price of the computer, that is 0.375 million. Another question, 15. T Limited is a telecommunication company. P Limited is engaged in generation and supply of power. T and P enter into an arrangement whereby T will provide 1 lakh minutes of talk time free to employees of P in exchange for getting free power equivalent to 20,000 units. Understood the deal? T will supply 1 lakh minutes of talk time. P will supply 20,000 units of power. A Limited normally charges 0.50 per minute and B Limited charges 3 rupees per unit. How will you recognize the revenue in this case? So how much revenue T will recognize? 60,000 or 50,000? IFRS 15 excludes non-monetary transaction between entities in same line of business. But this is not same line of business. Current scenario is covered under IFRS 15 because the goods and services exchange are dissimilar. So on the basis of the above, T Limited will recognize the amount the entity expects to be entitled for free talk time sold. So what is the consideration they have received? They have received 20,000 units of power. Each unit of power is 3 rupees. So consideration received for the talk time sold is worth 60,000 rupees. How much revenue P will recognize? P sold 20,000 units of power and they received consideration in the form of 1 lakh minutes of talk time whose fair value is 50,000. So the amount can be different in different books. Okay. Consideration payable to a customer. Consideration payable to a customer includes cash amount that entity pays or expects to pay to the customer. So nowadays this kind of scheme is very popular. Consideration payable to the customer means you buy now and we will give you a coupon, a voucher. In some countries they call stamp. Okay. Sometimes they call loyalty points. Some airline call miles. Okay, JP miles, air miles. So what is this? This is nothing but some amount you are going to pay to the customer in future. Consideration payable to customer includes credit or other terms which can be applied against amount owed to the entity or to other parties that purchase the entity's goods or service from the customer. An entity shall account for such consideration payable to a customer as a reduction of transaction price. Now first you write one journal entry for this. Okay. Suppose you sell goods of 10,000 rupees. 100 rupees is equal to 1 point. 100 rupee equal to 1 point. So how many points the customer will get? 100 rupee equal to 1 point. He buys goods of 10,000 rupees. So how many points he will get? 100 points. Each point is equal to 2 rupees. So 100 points will be equal to how many rupees? So what they do? They say that we will transfer 200 points, 100 points to your customer loyalty account. In future, you can redeem these 100 points, which is worth 200 rupees. What entry will they pass? Bank account debit 10,000. So actually there are two obligations involved here. One is to sell the goods today, to revenue, and to liability. This 200 rupees will be treated as a liability towards the customer against future purchase. And 9,800 is the amount of revenue you are going to recognize. In future, when the customer will purchase the goods, this account will be debited. Or if there is a deadline, after the deadline is over and these points are not utilized, then it will be treated as revenue. Is it right? So this is how this customer loyalty points work. But this was a simple example. Now one more example on financing arrangement with journal entries. In your book, this is question number 16. Limo PLC entered into a contract with CN Inc. to sell machine X and Y. According to the contract, CN Inc. will pay a consideration of 75,000 upfront. Okay. What is upfront? In advance. But how many machines he wants to buy? He wants to buy 2 machines, X and Y. CN has agreed to provide machine X after 2 years and machine Y after 5 years from the date of contract. Limo feels the transaction price can be allocated to machine X and Y in the ratio of 20:80. So 20:80 is 75,000, has 2 components. X and Y 20:80. How much is for X? 15,000. How much is for Y? 60,000. Okay. The appropriate finance cost for the entity based on the average cost of capital is 6%. This is your cost, finance cost. How should this company recognize the revenue arising from the contract? In this example, we are getting the advance. Okay, 75,000. Machine X will be supplied after 2 years. Machine Y will be supplied after 5 years. So this amount is paid in advance. So therefore it is the customer who is financing you. Customer is financing you. So of course you are going to give him some concession here if he is going to finance you. So while calculating the revenue to be recognized, on 15,000 we'll consider interest for 2 years, and on 60,000 we'll consider interest for 5 years, and that amount will be recognized as revenue. Okay. So in case if they ask you to pass journal entries, how will you pass the journal entries? So first is allocate the transaction price in the ratio of their standalone prices, which is 20:80. So transaction price allocated to machine X 15,000, Y 60,000. Have you completed the performance obligation on day 1? No. The performance obligation is to deliver machine X and Y. So therefore on the day 1 tick mark, you will not recognize revenue. You will show the amount received as liability. So journal entry number 1, first year beginning, cash account debit tick mark 75,000 to contract liability account 75,000, being amount received upfront. Now what happened? There is no other transaction in this year, but there is a significant financing element involved here. The customer has given you advance. It is like a loan given to you. So you have to pay interest for 2 years first. First year interest will be interest expense account debit to contract liability 4500. Check the calculation. Is it right? Yes. This interest expense you write in bracket P&L account. Unwinding of discount. What about year 2? How much interest you will pay? Interest you will be paying on 75,000 tick mark plus 4500 into 6%. Into 6%. How much is that? 4770. 4770. And then in the second year, machine X will be transferred. So now I am going to recognize revenue with respect to machine X. Can you pass the entry? Contract liability to revenue, but not 15,000. On 15,000, you have to compute interest for 2 years. We have already calculated interest for 2 years, 4,500 and 4770. Just take 20% of that. Or you can take 15,000 on your calculator plus 6%. Plus 6%. How much you are getting? 16,854. Correct? So machine X has been sold, revenue recognized. Now my carrying amount will change. So first you understand this carrying amount right now. In the beginning we had 75,000. Add interest for 2 years. Minus this much revenue recognized. So beginning of year 3, the balance is 67416. Is it right? Check. So calculate interest on that for year 3. 67416 into 6%. 4045. Tick mark. To contract liability 4045. Then again year 3. Interest expense account debit to contract liability. Now you will calculate interest on 67416 plus previous interest 4045 into 6%. How much it comes to? 4288. Year 3 again. First compute the interest on 67416 plus 4045 plus 4288. Total amount into 6%. Is it 4545? Yes. Now year 5, we will recognize revenue when we will transfer machine Y. Tell me the total amount now in your books.
50,000.
Is it 80294? Have you checked or copied? Very good. Contract liability account debit to revenue account 80294 being recognition of revenue. Now one more question quickly. Question number 17. Jailo PLC entered into a contract with Milo to sell machine A and B. Under the contract, Milo will pay consideration of 50,000 upfront. CN Inc. CN, from where CN has come? Jailo Inc. has agreed to provide machine A immediately and machine B after a year from the date of contract. Jailo feels that the transaction price can be allocated to machine A and B in the ratio of 40:60. This should be Xylo. Copy paste problem. The appropriate finance cost for the entity based on its average cost of capital is 10%. Now in this problem, when are the machine to be delivered? Machine to be delivered is machine A immediately and machine B after 1 year. Okay. Cost of capital is 10%. How should Limo recognize the revenue arising from this contract? So they may ask you a simple question like this or like previous one where you may have to do more accounting. So first, what is my task? If I have to deliver 2 machines, I have 2 performance obligation. Apportion the transaction price in the ratio of 40:60. 20,000, 30,000. Okay. So I will first recognize the consideration received today as a liability. Bank account debit to contract liability 50,000. And then in the year 1, we are going to deliver one machine A. That revenue will be recognized. Machine A is sold. Performance is complete. Contract liability account debit to revenue account. But after 1 year, you have to recognize the interest. During the first year from the contract inception until the transfer of machine B, we need to recognize an interest expense of 30,000 at 10% for 1 year. You should ask one question. Up to 1 year, we may not recognize the interest. But if they have given you the interest rate, it means they expect that the student should take interest for 1 year. But otherwise, for a small amount or small period, interest can be ignored. So interest expense to contract liability 3,000. And now you will recognize machine B at the end of when we have to deliver machine B after a year from the date of contract. Contract liability account debit to revenue account. Whenever you will deliver the asset, contract liability to revenue 33,000. Okay. Now one more question. A seller provides sales incentive to a customer. This is based on where we give some benefit to the customer when entering into a contract. For example, it provides free goods. After the seller normally sells free good that the seller normally sells or provides as a part of its business. For example, on purchase of 2 goods, the third is free. Wow. How should an entity account for such sales incentive? Nothing is free in this chapter. Okay. So you are charging for 2 and giving 3 products. So what will you do? You have to apportion the transaction price over the different performance obligation. So you have actually performance obligation like this. 2 products you are going to sell and the one product you're going to give free, the transaction price will have to be allocated over that free product also. So entity grants free in inverted commas, nothing is free, to a customer as a part of sale transaction which it sells separately as a part of its operation. Transaction price is allocated to each separate component based on IFRS 15, which require that revenue from the sale of the goods shall be recognized when entity satisfies a performance obligation by transferring a promised goods or service. So in the current transaction, total consideration will be allocated to all the elements of the sale, including the free goods. Okay. So this standard will change the way in India the accounting was done, or in all other countries also, because many times we were not recognizing the free goods as revenue. Now you have to recognize it. Next point, there was no number crunching in the previous example, only theory discussion. Now number crunching. A manufacturer enters into a contract to deliver a product to customer for 5 lakh. Customer pays a deposit of 2 lakh with the remainder due upon delivery. So here it is part payment in advance. Delivery occurs 3 weeks later. Underline, the problem itself says significant financing component does not exist. Ignore finance. Revenue will be recognized upon delivery. This is the time when control is transferred to the customer. How should manufacturer present the advance payment prior to delivery in the SOFP? It will appear as a liability. Okay. Rupees 2 lakh deposit was received in advance of delivery. So the producer should recognize a liability of 2 lakh. And when you actually deliver the asset, deliver whatever that product was, that time you'll pass this entry: contract liability account debit, cash account debit to revenue account. Now we'll come to one more important part of this chapter: criteria for recognition of contract cost. Earlier there was a separate standard on contract cost. Which was that standard? IAS 11, construction contract. Now those paragraphs which were there in that standard have been incorporated under this standard, of course with some modification wherever required. So this one single standard will deal with revenue from construction contract also now. Earlier there were 2 standards. There were some interpretations also. All these have been merged into one. How does contractors recognize revenue? Now it is not just construction of a fixed asset like land or like a building, flyover. It can be any such long-term contracts. What would be included in contract cost? What would be included in contract cost? So contract cost will include the incremental cost of obtaining a contract. What is incremental cost of obtaining a contract? These are those costs that an entity incurred in an effort to obtain the cost. Cost which you have to incur if you want to get a contract. If this contract would not have been there, this cost could have been avoided. Is it right? The cost could have been avoided if the contract would not have been there. So these are called incremental cost. This cost have been incurred because you have to satisfy a performance obligation. Incremental costs are those costs that entity incurs in order to obtain a contract with a customer, and that it would not have been incurred if the contract would not have obtained. For example, a sales commission. Or for example, suppose you have to develop a software This can be also a contract. Develop a software. In order to develop a software, you would need some more software. The cost of those other software or any other such thing that you need will also become incremental cost. The question is, what is the treatment of incremental cost? Would you recognize it as an asset first, capitalize it, and then apportion it over the contract period, or would you charge it to P&L account immediately? Two answers are possible. Those costs which will be recovered from the customer will be capitalized first and will be apportioned according to the progress of the work done. Okay. Let's say, for example, you are doing a construction of a building. That is easy to understand. Who incurs the cost first? The builder, the contractor. Okay. And later on it is recovered from the customer. So first he will keep on accumulating the cost incurred under a heading called contract cost account or contract asset account, and then he will recover it proportionately. When will you treat it as an expense? Reverse the previous answer. If the cost cannot be recovered. So cost to obtain a contract that would have been incurred regardless of whether the contract was obtained, unless these costs are specifically chargeable to a customer. So in short, costs which cannot be recovered from the customer. These are those costs which you would have incurred in any case, like administration cost. Okay, which cannot be recovered from the customer. Now what about the further treatment of contract cost? The standard says, if suppose the amortization period of the asset that the entity otherwise would have been recognized is less than 1 year. In such cases, the contract cost will be recognized as expense. If you are working on a short-term project, you can charge it to P&L account. But in case if you are involved in an asset which will take longer term, 3 years, 4 years, then in that case, we will not transfer it to P&L account immediately. First of all, we will see, does this contract cost results into creation of separate asset which will be covered by another standard? If the answer is yes, then those assets will be capitalized and treated under other standards. Like for example, in order to say construct a building, you may buy a machine, a bulldozer. Bulldozer will be first capitalized under 16. Is it right? Or in order to develop a software, you may yourself purchase a software first. That will be capitalized under IS 38. In order to construct the building, you may purchase bricks, sand, cement. First you account it as inventory, and then as and when you consume it, you charge it to contract cost. If the cost incurred in fulfilling a contract with the customer are in the scope of another standard, entity shall account for those costs in accordance with other IFRS. Otherwise, an entity shall recognize an asset from the cost to fulfill a contract only if these costs meet all of the following criteria. Other costs will be first capitalized and then accounted on proportionate basis, but following conditions must be fulfilled. One, these are direct costs. What do you mean by direct costs? Which are directly related to contract or incurred in anticipation of a contract that the entity can specifically identify. Examples are printed in a small table below. We'll come to that. For the timing, the example of direct cost would be direct material, direct labor, designing an asset to be transferred under a specific contract. Second is the cost generate or enhance resources of the entity. So the cost that you are incurring results into creation or enhancement of resources of an entity that will be used to satisfy the performance obligation in the future. Like think about a contractor who is constructing a building. So as and when he is constructing a building, it creates or enhances the resources. His contract is to construct a building and then transfer it to the client. So second condition is that whatever expenditure you are incurring should result into creation or enhancement of resources. And the third one, the cost should be recovered. Okay, direct cost should result into creation of or enhancement of resources like an asset, or third is the cost should be recovered from the customer. If these conditions are satisfied, what I am going to do, I am going to first debit them under a head called contract cost or contract asset, and then we will apply stage of completion for recognition of this cost. Some example of cost which are directly related to a contract. Direct material. Example, supplies used in fulfilling the contract. Direct labor. Salary and wages of employees who provide the promised services directly to the customer. Then some cost which can be allocated to the contract or to contract activities. Like for example, cost of contract management and supervision. Because this cost may be incurred for more than one contract, but ultimately incurred for contract activity only. Allocate it if you can allocate it. Insurance, then depreciation of tools and equipments used in fulfilling the contract. Fourth, contracts costs that are explicitly chargeable to the customer under the contract. That is, those costs which are mentioned in the contract and the customer will pay you, and other costs that are incurred because the entity entered into the contract. For example, payment to subcontractor. These are the examples of direct cost. Which cost will not be included in contract cost, and this will be treated as an expense as and when they are incurred. Is it right? Example of such cost which will be charged to P&L account as and when they are incurred. Administration cost, general cost, general overheads. Again into bracket they have written, unless these costs are explicitly chargeable to the customer under the contract. So you have to mention it in the contract that we are going to charge a certain administrative cost. Next is cost of wasted material, labor or other resources. This will not be charged to the contract. Wasted material, labor or any other resources to fulfill the contract that were not reflected in the price of the contract. And the third is costs that relate to satisfied performance obligation. Costs that relate to satisfied performance obligation in the contract. For example, costs that relate to past performance, previous performance, ignore. And similarly, costs related to remaining performance obligation that cannot be distinguished from the costs related to satisfied performance obligation. So future cost also ignored. Cost already related to satisfied performance obligation will not be considered, and cost relating to remaining performance obligation. Now the task is how to amortize this cost. How to amortize the contract cost. So which method we will follow? Point of time or over the period of time? There are two methods. On one extreme, point of time, and on the other extreme, over the period of time. Over the period of time we will follow when either of the three conditions are fulfilled. One is The customer enjoys the benefit as and when the services are rendered. That condition is not fulfilled. It results into creation or enhancement of an asset or a resource. Yes. It results into creation of a unique or specialized asset which cannot be used by any other one. So it may be yes or it may be no also, depending upon what you are constructing. Huh? Possible? Not possible also. So it may be yes or it may be no. So we'll follow over the period of time method, which means we will recognize revenue as and when the transfer of goods or service is taking place. Capitalized costs are amortized in a manner consistent with the pattern of transfer of goods or service to which the capitalized cost relate. If an entity identifies a significant change in the expected pattern of transfer, that is also possible, then it updates its amortization to reflect the change in estimate in accordance with IAS 8. What is IAS 8? IAS 8? Accounting estimate, change in accounting policy, prior period errors. Okay. Because this is such a business where the estimates are likely to change. The contract goes over for many years. In so many years, the revenue estimate change, the cost estimate change, the pattern of transfer of benefits changes. So therefore, this standard or this part of the standard will be highly subject to estimation. So keep on applying IAS 8 every year. Now one question for you. ACS Limited. ACS Limited enters into a contract to outsource a customer's information technology data center for 5 years. What is the activity of ACS? What is the performance obligation of ACS company? It will outsource customers information technology data center. That means they will keep the data, IT data, in their respective whatever server or whatever you call it for 5 years. ACS Limited incurs a selling commission cost of $10,000, you make it 10,000 to obtain the contract. Who charges $1 only? So selling commission of $10,000 to obtain the contract. Is it incremental cost? Say yes or no. Yes, because this cost would not have been incurred if you would not have got this contract. So incremental cost, recovery of which is probable, will be amortized. Okay. Before providing the services, ACS Limited designs and builds a technology platform. So now they are incurring other cost to fulfill their obligation that interfaces with the customer system. That platform is not transferred to the customer. Platform means whatever technology backbone that you create so that you can provide the technology data center service to the customer, and for that you have to create some infrastructure. The customer promises to pay a fixed fee of 20,000 per month. So this will be a revenue in future. The $10,000 incremental cost of obtaining the contract are recognized as an asset. As we discussed earlier, this incremental cost can be recognized if it can be recovered. The asset is amortized over the term of the contract. The initial costs incurred to set up the technology platform are as under. In order to provide this service, you have incurred the following cost: 40,000 design service, 1,20,000 hardware cost, some software you have purchased 90,000, and migration and testing of data center is 1 lakh. So total cost is 3,50,000. The question is, how will you do the accounting of this entire cost incurred? Some asset that you have created, like hardware and software. Now these are your asset. This, as the question says, will not be transferred to the customer. So that will be accounted as per respective standard. Hardware will be accounted under PPE number 16. Software will be accounted under 38. What about this design, service and migration and testing of data center? These are also direct costs. So that we will capitalize and we will amortize it over the period. Okay, a period of 5 years. So the initial setup costs relate primarily to activities to fulfill the contract, but do not transfer goods or service to the contract customer. The entity would account for initial setup cost as follows. You are not going to hand over any of these instruments or the software to the customer. This cost you have incurred so that you can satisfy the performance obligation. So according to other standard, first you check which item will fall. Hardware, IS 16, software, IS 38, cost of design, migration and testing of data center. Now these are also direct costs incurred in connection with this contract, considered for capitalization. That is incremental cost of obtaining a contract with the customer if the entity expects to recover those costs. Any resulting asset will be amortized systematically over 5 years as the entity provides the services outsourced by the customer. So this you will account over 5-year period. In this example, it seems that the revenue is even. So accordingly, you can recognize the cost also. Okay, now one MCQ type question. What is MCQ type? One question, 4 options. Okay. What are the when are incremental costs recognized as an asset? Don't read the answer, only on the screen. If the entity expects to recover those costs from the customer, entity does not expect to recover those costs from the customer. If the entity expects to incur such cost over a long period of time, if the entity wants to defer such non-recurring expenses. A. Sure. Lock. A. Yes, the right answer is A. Because the option is very clear. The entity expects to recover this cost from the customer, then you capitalize it, otherwise not. Now, next is contracts where performance obligations are satisfied over a period of time. So, what is the rule of recognition? If you don't want to read that whole paragraph, one line, it should be based on proportion of contractual obligation satisfied. Okay. For contracts where performance obligations are satisfied over time, revenue is recognized based on calculation of progress made towards complete satisfaction of performance obligation. Is it right? Which means proportion of contractual obligation satisfied. And this formula that we learned yesterday, output method, input method, this method would be usually applied for construction contracts, but not necessarily construction contract only. Any contract which takes a long period of time, usually many years. So therefore we need to find out what is the most appropriate way to recognize revenue and the cost. Because as and when you are doing the work, you are creating or enhancing or generating an asset for the customer. So therefore, over the period of time criteria is satisfied. Once it is established that control is transferred over time, the entity needs to measure the progress to satisfaction of the performance obligation arising by using any of the method prescribed. So just tell me, did we discuss input method and output method earlier? Yes. So no need to discuss them again. You can check it later. The revenue recognition and the amortization of contract cost is done in a manner consistent with the pattern of transfer of goods or service. So here the question will be in the exam, a company says we want to transfer equally over the contract period, all cost, all revenue. Allowed? Equally. Contract cost and contract revenue, they want to allocate equally over the construction period. The answer is no, unless the work performed is evenly distributed, which is very unlikely. Sometimes they say we will recognize it after the completion of the entire project. That is also not allowed, completed contract method. If it fulfills the definition of control transfer over a period of time, then we have to recognize percentage basis. Okay. The revenue recognition and amortization of cost is done in a manner consistent with the pattern of transfer of goods or service. Long-term contracts are subject to some uncertainties that are not applicable to other transactions, but they have introduced the concept of prudence in the standard. What is the concept of prudence? The concept of prudence is that you are allowed to recognize profit only when the outcome of a performance obligation can be estimated reliably. That is called prudence. Can you estimate the outcome of the contract reliably? What is that outcome of the contract? It means, can you estimate what will be total revenue? Can you estimate what will be total cost? Revenue minus cost will give you estimated profit. Today we had solved one problem in the beginning when we started, that you are managing the funds on behalf of a client and you get some commission if your performance is above the benchmark index. But we had not recognized revenue till the end of the year. Why? Because the outcome of the performance obligation cannot be estimated reliably. So we have to wait. So in case of construction contract also, if the outcome of a performance obligation cannot be estimated reliably, and that may happen if it is a long-term contract, wait. Revenue will be recognized only to the extent of cost incurred. What is the rule here? Revenue will be recognized only to the extent of cost incurred. So how much profit will be recognized? No profit. But when you can predict the outcome of the contract reliably, then revenue and cost will be based on percentage of completion. So rules of recognition are divided between two classes. Outcome of the performance obligation can be estimated reliably, which means revenue can be estimated, total cost can be estimated. Okay. Therefore, you can estimate what would be the gain or loss to the company. And when the outcome of a performance obligation cannot be estimated reliably. In the early stage of a contract, we are going to follow normally this rule. Work has just started, 5%, 10%, 15% work is over. And it is a highway which is going to take 6 years to complete. We don't know finally where we will end up. So then don't make profit, right? Don't recognize profit. You will recognize revenue to the extent of cost incurred. But if you can demonstrate we are here, outcome can be estimated reliably, then you are allowed to recognize revenue, okay, on the basis of percentage of completion. So the revenue is calculated using the transaction price. So estimate the transaction price. What will be transaction price equal to? Transaction price will be equal to whatever you have agreed plus any variation also. What is variation? You may get incentive. You may have to pay penalty. Okay, or any credit risk and other factors which may impact the transaction price. So estimate transaction price keeping in mind the variable factors also. Like some contractors get incentive if they complete the work on time or before time. So you have to see whether this incentive can be estimated reliably. Then you can include that also in estimating the contract transaction price. But the standard again introduces the concept of prudence. If you find that there is any expected loss, what do you mean by expected loss? My expected contract revenue is 1 million. My expected contract cost is 1.2 million. So my expected loss is 0.2 million. So we have to provide this much loss. Again, you can say we are introducing what is called in accountancy prudence. And that is not because of this standard. That is because of another standard. IAS 37 provisions, contingent liabilities and contingent asset, where they say if a contract is an onerous contract means economic benefit is less than economic cost. In this example, economic benefit is 1, economic cost is 1.2, contract has become onerous. We need to make the provision. We need to make the full provision. Okay. Thus, in the case of loss making contract, only unavoidable costs are considered and the loss is recognized immediately as an expense. See one example first, how this chapter will move now. You can get an independent question on this. Okay. Golden Construction Company is executing a contract worth $15 million. The outcome of this contract can be estimated reliably. If this sentence is given, it means we will follow percentage completion method. On 31st December 2086, that is at the end of the reporting period, it estimates that 50% of the obligation has been satisfied. Very good. So what is the accounting treatment? 50% of the expected transaction price will be recognized as revenue and 50% of the expected total contract cost will be recognized as expense. So automatically the profit will get recognized. The entity keeps the track of the progress of the work as well as the cost of the work done. When it is probable that the total cost will exceed total revenue, after considering the impact of impairment and credit risk, if any, this indicates that there is likely to be an overall loss. And then what will you do? In case if you find that there is going to be loss at any stage, the entire loss will get recognized. Okay. This treatment is given in IAS 37 because IAS 37 deals with onerous contract where the cost is more than benefit. The standard also makes it clear the loss will be provided. The loss will be provided irrespective of the following. That means even if the work has not commenced, the loss may be provided. Student will ask the question, why do you take such contract where at the beginning only, before the commencement only, we know that we are going to incur the loss? Yes. Answer from the student. Why do you take such job where before commencement only you know that there is going to be a loss? Huh? It can be a group company. So subsidiary may do the work for the parent company on a loss. Then it may be a government company. So how does it matter? It is government company. Customer is government. So it's a reputation. That means once you get the job from the government, it increases your goodwill and you might get some other contract also. So sometime in order to build goodwill, yes, we work at a lower price. And then once the relationship becomes stronger over a period of years, then we start charging higher price. And even the customer, he gets confidence in us and then he gives us bigger projects also. Okay. So when the contract work has commenced or not, sometimes there can be regulatory reasons, whatever may be the reason, we are not interested. But yes, this is possible, that you should know. Second thing, it does not depend on how much work has been done. Irrespective of the proportion of work done, 5% or 80% or 90%, the moment you see there is going to be an expected loss, make full provision. And also it does not matter other contracts are making profit. Other contracts may be making profit, this may be generating loss. Still you will have to make provision for full loss on this contract. Okay. Some terminologies we'll understand before we go to accounting. What is the meaning of progress billing? Progress billing means amount invoiced over a period of time. As the work progresses, periodically the contractor raises the bill on the contractee after getting the work certified from the architect, engineer, surveyor. So this is the highway. Say 25% work has been done. He will raise a bill, get the work certified. Again 50% work has been done. He will raise a bill. 75% work has been done. 100% work has been done. This way he raises the bill. Customer will read the bill. What he will do next? He will make the payment. He may not make the payment also. He may make full payment, he may make partial payment. So generally, in long-term contracts, the customer will make only a partial payment. Of course, it depends on case-to-case basis also. He may have to make full payment also. He may have to give advance also sometimes. In many businesses now, the contractor will ask you to first pay the advance and then he will start the work. But let us assume he will pay part payment. Okay. For the accounting purpose, progress bill amount minus amount received from customer, the difference is called trade receivable. It will appear as a current asset in the book. Say for example, there is a contract, sale value $7 lakh, and at the end of the reporting period, an entity estimate that 30% of the performance obligation has been satisfied. Is this example there? Somewhere below? Not below also. Okay, we'll just discuss on the screen. Not very important, very easy. Total sale revenue $7 lakh. At the end of the reporting period, an entity estimate that 30% of the performance obligation has been satisfied. The outcome of the contract can be estimated reliably Management wants to recognize 30% of the profit. Do you agree? Is it there? Towards the end also? 30. I know you people are smart. First you will search the question. Okay, question 32 towards the end. Now again read the problem yourself and suggest me the answer. At the end of the reporting period, the entity estimates that 30% of the performance obligation has been satisfied. Outcome of the contract cannot be estimated reliably. Underline, cannot be reliably estimated. And still this company wants to recognize 30% of the profit. Do you agree? No. Then how much revenue and how much cost you will recognize? So the answer is, when the outcome cannot be estimated reliably, the performance obligation satisfied basis will not be followed. The entire cost incurred is recognized as expense and the revenue is recognized only to the extent that the recovery of the cost is probable. So you tick mark this question because it discusses one of the provisions of the standard. The provision is that if the outcome cannot be estimated reliably, cost incurred will be recognized as expense. Revenue will be recognized only to the extent the recovery of the cost is probable. Is it right? So this is the the standard provision for those contracts whose outcome cannot be estimated reliably. That is, you don't know what would be the end result of this contract. Now we will take a break.